Hello, and welcome to another special edition of Zacks Shopping for Stocks. I'm your host, Maddy Johnson, an editor here at Zacks, and today I'm joined by Eric Ervin, the CEO of Reality Shares. Eric and his firm are solely focused on dividend growth investing through 4 ETFs, the Leaders Dividend ETF, DIVCON Dividend Defender ETF, Dividend GUARD ETF, and the Reality Shares DIVS ETF. Reality Shares is dedicated to giving investors access to the real power of dividend growth investing. As we find ourselves in the thick of Q2 earnings season, Eric and I discussed 4 hand-picked winners and losers that he predicted from one of the most troubled industries, retail. Most retailers report at the end of each season, so we'll have to report and see if his predictions hold true. Check it out. Eric, welcome. Thank you for joining me today.
Thanks for having me.
So, for listeners unfamiliar with the basics of dividend-focused investing, can you explain some characteristics of this investing methodology and how Reality Shares utilizes dividends to its advantage?
Sure. So, if you look back, this is really kind of the essence of how Reality Shares thinks about all investments. If you look down at the basics when we're investing in a company, what we're really looking for are the earnings of the company and those earnings that can be returned to the shareholders. And they can be returned typically in a number of ways, but one of the most real, and that's the reality behind Reality Shares, is in the form of a dividend. You can't fake a dividend. You can manipulate your earnings, you can do a lot of things, but you can't fake dividends. And dividends have been a very important part of the return on the market. So they've amounted to about a third of all the returns that have ever been earned by the S&P 500 have come in the form of dividends. But even more so, and this is where I think we start to differ from a lot of other firms, is the growth of those dividends. So companies that can grow the dividends perform far better than the companies who just pay a constant, steady yield. And so we really want to focus on those companies that can grow their dividends in the future, not necessarily have the highest yield, but have that highest growth potential. And that's really where we fall into the kind of scheme of the overall investment universe.
That's a really good motto. I like that. You can't fake dividends. It's a good tagline.
Yeah, thanks.
So I know you have some retail earnings predictions, which we'll get to in a little bit. Very excited about that. But I wanted to get your take on the retail industry as a whole. So while your firm tracks retail companies through its proprietary dividend rating system, DIVCON, am I saying that right?
Yeah.
And Reality Shares holds several retail companies in its ETFs. What do you think of the beatdown the overall industry has taken in recent years?
I think it's kind of a tale of two markets. So on the whole, you're right. You're going to get some pretty significant headwinds in the just brick and mortar retail from these online retailers like Amazon especially. You know, in every business or in every sector, there's a number of shining stars. And in the case of just the retail sector as a whole, so we went back, and again, with this whole dividend health rating system, really what you're doing is you're finding the highest quality companies with the highest potential for growth. So if you broke it down, the retail sector, by those companies with our highest dividend health rating and those companies with the worst, the companies with the highest health rating outperformed the others by a wide margin. They were only down about 13% the sector was down about 13% versus those healthiest companies being down about 8%. So they have gotten beaten up, to be sure, but it's the ability for those high-quality companies to be resilient and have that balance sheet and the health of the balance sheet to kind of stick it out, even when the sector as a whole is kind of getting taken out to the woodshed.
So kind of bringing it back to Amazon, which you mentioned. So the rise of and reliance on Amazon has not been good for a lot of brick and mortar retailers. And as many consumers change the way they shop, preferring to shop online rather than going to the store, for instance. So these retailers will need to keep adapting to their core customer base, whomever that may be. What do you think are the biggest challenges facing traditional retailers today?
So the understanding their customer is probably first and foremost. I think nowadays with consumers are a lot pickier, and they want it the way they want it and when they want it, and that's what Amazon's been able to do so well. If you kind of look back 15 years ago at our shopping experience, it was much different than it is today, and that's mainly because of the convenience that the internet has offered us. But then on the flip side, there is a certain aspect to those retailers who can understand, like Apple's a great example of that. Apple could have just gone with an online-only model, but instead one of their shining kind of beacons of success has been that store, that brick-and-mortar store where people can walk in and touch and play with and see their new products. And so that's only going to happen well for the companies who execute, understanding what their customer wants and how to give it to them in the way that they want it. And they can take advantage of this newer mode of delivery, whether it be subscription-based or through a brick-and-mortar or both, that combination. But vice versa, it's peril for those companies who just don't get on the bandwagon and understand what they can possibly get themselves into or out of in terms of a sticky situation, a la Barnes & Noble or some of these other stores that just didn't figure it out.
I like that you mentioned the Apple Store. What do you think is the difference between the Apple Store and Microsoft's version? Like, why do you think one has been successful and one hasn't caught on so much?
Yeah, and there's another gateway tried this as well, and so a number of companies have tried well, it worked for Apple, let's do it ourselves, and not so much. And I think one is really that just almost like religious
it's called like following. Yeah,
they just have this ability to engage with the customer on so many different levels. But their products they have that kind of cool factor, and you want to touch them and hold them and feel them, and even just the experience. Like the employees love to work there, and it really shows through when you show up at that store, and everything right down to the smallest detail has been thought of. Where I think the copycat model, it's very hard to capture that lightning in a bottle, and then just come out with that. So if I'm just anecdotally speaking from my own experience, going into a Microsoft store in our mall versus which I think is shutting down now actually, versus going into the Apple store, the experience was so much different from a quantity of support staff to the size, and it was all jumbled, and you didn't really know what was what and where you could go and engage with the product. And whereas Apple, everything was tight and clean, and you kind of knew exactly what you were going to get at each of the different zones, if you will.
Yeah, I definitely agree with you. I've had those same experiences in both stores. So I know you kind of briefly mentioned it before, but I think it's always interesting to think about the retail environment in the past and the retail environment today. So what would you think if you or I were to tell someone 15 years ago what the state of the retail industry is like today? Do you think they would have a hard time believing you, what it had come to?
Oh, yeah. I mean, just like even every day, I'm blown away at how fast even just Amazon has surprised all of us, where 15 years ago, Amazon was a bookstore online, and even that, people were curious about whether or not this newfangled bookstore, and whether or not that's going to take over. And now it's an everything store, and people are getting things within an hour delivered to their address. It's just amazing how they can completely turn that whole shopping experience on its head for so many things, from a toothbrush to a book to a car, potentially. And that's where I think people are really shocked and should be, if they could have fast-forwarded to the future. And even just 5 years from today, I'm sure it's going to be meaningfully different, and it will continue to evolve as well.
Yeah, I always think about the shopping mall and how fast it kind of went downhill. Because 10 years ago, that's where I went shopping. If I needed to go shopping, I would go to my local mall. But now that doesn't even occur to me anymore. So times do change.
Yeah.
So moving on to your retail earnings predictions, I want to start with the potential losers of our Q2, just so that we can kind of end on a high note. But our first one is Staples, which trades under the ticker SPLS. So one of the biggest office equipment and supply chains, Staples' business has suffered as the demand for paper-based office products decreases due to technological advancements. So what factors make Staples a loser this season?
I think it's bigger than just this season. Well, this season's really important, but it's almost like that whole business model where with a lot of the Staples customers, they're going to be business customers for obvious reasons, and they're a little bit more price conscious, and they're in an office environment typically, and so they're very savvy when it comes to ordering what they need to order on the internet. And that has been basically completely disintermediated now with the Amazons and other office supply online retailers. While Staples will have a presence, now they're only going to pick up a portion of that volume versus, in the past where they could get people going to their local place of business to buy what they needed to buy. So that's really a nail in the coffin for Staples, for one, just from a business model perspective, because again, kind of knowing and understanding your customer, that customer is very price conscious and they aren't as specific to the potential brand of where they get what they get. They're more just concerned with what they get, and they can get that commodity anywhere now.
Right. Now, does the same argument apply to a company like Office Depot?
Yeah, I think it does. And that's where really all of those online brick-and-mortar retail-friendly locations where you're going in and buying something that's really commoditized and doesn't really have the value add, they're going to have to figure out ways to either figure out a service model or figure out something else that keeps people coming to their outlet. And that's going to be very difficult for them. If you look at Staples' stock performance, so just, kind of like play this out, for the past 15 years since 2000, the stock hasn't produced a single dollar for the shareholders. It's actually flat. It's produced a lot of stomach acid as it rose and fell, but it hasn't really produced a return. And I think that's a perfect example of the reality behind these. Are just really difficult businesses to figure out a way to make money in now as the market is moving away from them.
Yeah, I agree with you. So moving on to your second losing prediction is Bed Bath & Beyond. Get a coupon from Bed Bath & Beyond and almost every day in my mail. But the company trades under the ticker BBBY. Bed Bath & Beyond has suffered greatly against Amazon's rise, as the e-commerce giant offers many of the same products at both cheaper prices and with fast shipping. But sluggish store traffic and soft margins have hurt Bed Bath & Beyond's quarterly performance for a while now. Will these be factors again this quarter?
Yeah, I think that, and it's going to continue to hurt into the future. This is another example of a potential commoditized type of a retailer, and I kind of mentioned it before with the Staples as an example, where they're selling something that is fairly basic and benign, and you could order in a number of different places, and so you might tend to price shop, and that's where they have to get into this coupon game or this.
Sure.
It's almost like what happened with Macy's, where they were. Before it was like a few sales a year, and then it was a few sales a quarter, and now it's a few sales every day. Yeah. And then pretty soon, everything's on sale all the time, and nobody believes that it's really on sale or it's just utterly discounted. And that's kind of, I think, where Bed Bath & Beyond might end up going. And again, because it's towels or it's shower curtains or the things that we maybe need for our house when we move in. And like if my daughter's going to go to college at the end of next year, and I'm sure we'll be shopping maybe at a place like that. But that's really kind of a one-time thing. Perhaps where else we shop is just online, and we get those things online, where other retailers maybe know their customer a little bit better and can really offer them something that's unique and not so commoditized. And that's where the performance can at least hang in there in order to compete with some of these online resources. Looking at the stock price with Bed Bath & Beyond, it's had a great run since 2000. It was pretty volatile as well during the credit crisis, but it was really one of the highest flyers, outperforming the retail sector by quite a bit, right up until about 2012 or so. And then since then, it's slid almost 70%. And so kind of all in, an investor in Bed Bath & Beyond for 15 years has only earned about a 3% average annual return kind of over that entire time frame. So it hasn't been a good run from a perspective of a long-term equity investor. And I think a lot of that is just they're having a hard time competing in this market.
Now, do you think Bed Bath & Beyond would ever... See, whenever I go into a Bed Bath & Beyond, which, like you, isn't very often, but they seem to more or less capitalize on things that, like you said, you can't get really anywhere else. Like they have that weird aisle with as seen on TV products. Or do you think it's still popular with like wedding registries? Do you think in the future they would be able to capitalize on weird, unique corners of the retail market like that? Or, like you said, will it just devolve into a big coupon-y, discount-y store.
Yeah, and I think it's the management team there has some serious soul-searching and strategy decisions to make right now, because they still are specialty enough where they can win, and not all retailers will die on this kind of new economy if they figure it out. And so, just like you said, it's like they have this weird aisle or they have this, or if they can distinguish themselves as a unique provider of something, that people will come back to them. And a big chunk of the population is the baby boomer population that doesn't necessarily want to shop online. So if they can capture an audience and keep them, then they can end up with that loyal following. And then they just have to figure out how to manage all of that real estate, because there's an awful lot of real estate that's getting wasted as margins come down, as they get more and more special. So that's the other thing, is if you are going to specialize, then you better specialize on something that you can make a decent margin in. And towels isn't necessarily one of those. And so that's where they really have to figure that out.
Yeah, that's a really good point. Now, on to the winners. So, Eric, your first prediction here is TJX Companies. Trades under the ticker TJX, and this is the holding company of consumer favorites like TJ Maxx, Marshalls, and HomeGoods. HomeGoods is personally one of my favorite stores. I spend way too much money in there. My wallet doesn't like it whenever I go in there, but I digress. So TJX, it's a leading off-price retailer known for apparel and home goods that soared in popularity after the financial crisis not too long ago. So what makes this company stand out to you?
This speaks to that whole concept of differentiation and really understanding their customer. And in a world where we do have a significant population as boomers, and they are cost conscious potentially, and they do want what they want, but also some of the younger generation who wants that fashion item, but they're not willing to pay rack pricing for it. TJ Maxx is a great way to get those higher end brands and at still a kind of discount oriented prices, and you can try them on and feel them, and you're not necessarily going to find those at the Amazons of the world. They're just a little bit harder and kind of unique. So that's one thing. The other is just kind of understanding how to communicate with the consumer and let them know they've got this unique thing. It's in now. It won't be in later. Get it now. It's not that. So you almost have to have this repeat habit where you're constantly coming back in to see what they have that might, strike your fancy. So they've got a really good buying group that is just constantly filling the store with cool things that might bring people in just to see what's next or what else they might have. And like you say, with home goods, my wife and daughter and my son and I, we love going into that store because they just always have really cool things that, to make the house different and unique. And
absolutely.
I just think that it's, again, kind of understanding the customer and knowing that there's an opportunity here that I don't want to buy that thing online because I didn't even know I wanted that thing. But because I came into the store, now all of a sudden it's right in front of me and we like it. And so we end up spending too much money there. And that's, I think, one of the benefits of really understanding your audience and taking advantage of communicating it to them in the way that they need to be communicated to. That stock, by the way, has done phenomenal. It's almost done 11 times what the S&P 500 has done. So a traditional investment in just the S&P 500 15 years ago, or vice versa, in TJ Maxx would have been worth almost 11 times what a dollar invested in the S&P 500 would have done. So, clearly the market has woke up and understands it. And even though it's sold off recently, that has pales in comparison to the amount of money that it's made for shareholders up until this point.
So the second winner you've predicted to do well this season is Ross Stores, trading under the ticker ROST. Like TJX, Ross Stores is a popular off-price retailer that offers brand name and designer merchandise. The company has consistently beaten earnings expectations and is dedicated to their bold expansion plan. Will Ross Stores impress in Q2?
Yeah, so another example here, just very similar to the same things I just talked about with TJ Maxx, is someone who's kind of captivated the consumer. They offer brand names at a discount, so they're really kind of understanding that customer. they've got them coming back and coming back for more. Stock's done phenomenal since 2000. It's actually done even better than TJ Maxx. It's up almost 20 times what the S&P would have done. And it's one of the healthiest from a dividend perspective as well. So they really have this attention to kind of paying back the shareholders. And that's, like I said earlier, that dividend growth really drives stock price. But there's a deeper reason for that. It's a management team that cares that much about the shareholder and really understands how to drive business and revenue so that they can grow the dividends in the future. That's really what, one of the kind of fundamental characteristics of these great companies. But again, just the economy, for one. So people still, even 9 years later after the credit crisis, people still want to shop with an attention towards saving money, but they still want, higher-end brands, and they can trust the quality from stores like this because they can touch it and feel it and get a handle on what they're buying. And that, I think, has just led into a lot of the stock outperformance.
So I don't shop at Ross stores. I don't think I've actually ever been in one, but one thing I can say about shopping at a TJ Maxx or a HomeGoods is when you look at their price sticker, they'll say the original price and then what it's been reduced to. And I think that speaks to that mindset about captivating the consumer and how consumers still want to shop, still want those designer goods, but they don't want to pay necessarily full price for them, but they still want those nice goods, the apparel, the home goods. And I think that is a really smart, simple way of doing that and getting that average ticket price up in their stores. And it's an interesting thing to me. And I'm like, oh, well, if that was originally $45 and now it's only $15, that's a bargain. God, I have to get that now.
That's right. Yeah. In a way, they've kind of done what Target did, but they took it even one step further, which is, that kind of even Target, for so long had that Target, nice stuff, but at a good price. And this is nice stuff, but potentially even at a better price, where they're just really focused in. And I think that's been working. That's what the retail consumer really wants, is they want to be able to save money, but they also want to know that they're getting a high-quality product that they're going to look good in or that they're going to enjoy in their house.
I agree. Well, Eric, thank you so much for joining me on Shopping for Stocks. It's been great learning about these companies and your take on the retail industry. So thank you so much for coming on today.
Yeah, no, thanks for having me. And if, again, the system, if anyone cares, we keep a lot of this stuff on our website so that people can feel free to visit, or we do all this in our ETFs as well. So thanks for having me.